So you've just searched the cheapest way to liquidate my company. And right now you're looking at websites offering liquidation from £1,000, £2,000, £3,000. I want you to stop right now, because £1,000, £2,000 or £3,000, that is just the number to get you to pick the phone up. What no one is telling you on these websites, and what I'm going to show you in this video, is that once an insolvency practitioner is appointed, their job requires them to investigate the company's affairs and investigate you. And depending on what they find, and these firms will always find more, it generates more work for the insolvency practitioner. More work means more fees, and those additional fees you will end up paying. Now, I'm not saying that the insolvency practitioner is doing anything wrong. They're not. They're doing exactly what the law requires them to do. What I'm saying is that the £1,000, £2,000 or £3,000 headline figure that you're seeing on that website is nowhere near the real cost of your liquidation. Now in this video, I'm going to explain exactly how this works, what an insolvency practitioner looks for after they've been appointed, and the 3 areas that generate the most additional fees. And critically, what you can do right now to educate yourself so you understand everything that's about to happen. Now I want you to stay with me, because this video, I promise you, will save you money. It will save you time, and it's going to save you a significant amount of stress. Now, let me give you a bit of context, okay? Because I think it's very, very important. A creditor's voluntary liquidation, okay, or liquidation for short, it's the most common formal insolvency process in the UK. Probably 8 out of 10 insolvency processes are liquidations. So there is a huge market. And whenever there is a huge market for something, you will get firms competing on price. Now, here's something that I think tells you everything you need to know about cheap liquidations, okay? There's a governing body called R3. It is the Trade Association of the UK's insolvency and restructuring profession. Okay, a very well-regarded company, well-regarded body. By all means, go and look them up, right? And they have formally proposed to the Insolvency Service that a statutory minimum fee for a bog standard liquidation, okay, should be set at £10,000 plus VAT. £10,000. That is what the profession itself says is the minimum amount of money required to do this job properly in a standard liquidation. So, I don't know, maybe a handful of creditors, some staff that need making redundant, maybe a lease, maybe some small assets to sell. Now, they've not plucked that number out of thin air. They've done a lot of research, and they found that almost half of insolvency practitioners say that a straightforward liquidation costs them between £10,000 and £15,000 to complete when you account for all the work involved. Okay. So when you see an advertising saying that a liquidation can be done for £1,000, £2,000 or £3,000, ask yourself this. If one of the governing bodies says it should cost £10,000, how is it possible that anyone could do that for £1,000, £2,000 or £3,000? Now, before I walk you through the 3 areas that generate the most additional fees for directors, okay, I want to share something with you, and hopefully this will get your attention. I don't talk to you and do these videos from a textbook, okay? I went through a company insolvency myself. Like, literally, I was a director of a company about 12 years ago now, and I had to go and put it through liquidation. Basically, there was a change in government legislation. The business model was pretty much over overnight. I went out there, I researched everything on the internet, you know, surely I'd be able to figure a way out. And sadly, there was no way out, and I had to put the business in liquidation, and I met lots of insolvency practitioners, and it were a really scary time for me. I was spoken to like a naughty schoolboy, like a criminal, like really, like, honest to God, I had the weight of the world on my shoulders. And every company I spoke to, they made me feel worse. Listen, that's my truth. And what happened for me is, I just didn't know what questions to ask. And I went through the process, and then I started doing what I'm doing now. And I've been doing this for years. And I've been helping directors like you understand what their position is before they appoint an insolvency practitioner, okay? And I do it quickly. I've done hundreds of videos on YouTube. I've got hundreds of reviews on Trustpilot to help you make better decisions, okay? Decisions that you make in the coming weeks and months, okay, potentially are going to follow you around for years, okay? Now, if I'd have known then what I know now, I'd have handled my insolvency very differently. And that experience is why I make these videos. They're not to scare you, although some of them may make you feel scared. They're not to sell you something you don't need, but they're there to give you information that most directors wish they'd had before they went through insolvency. And I get emails and inquiries every week saying, Chris, I wish I'd have known about this video before I went through an insolvency process. Can you help me? And the truth is once you've gone through an insolvency, and once you've appointed an insolvency practitioner, I can't help you, okay? Now, what I want to do now is talk about what an insolvency practitioner actually looks for. By the way, if anything I've said so far has made you think, you know what, I want to talk to him, go to the comment section. There is a link at the top. Click the link. You will be able to book a call with one of my team today, and we'll help you understand your options. Or if you don't really want to speak to somebody, go to the channel homepage, and there's a free guide at the top. You'll just have to give us your email address, and we'll give you a free guide around insolvency, okay? So, let me cover 3 specific areas that are going to end up costing you more money, okay? And at the end of this video, I'm going to give you a practical checklist of what you can do on each one before you appoint anyone, okay? So stay with me. Right, let's get into it. So once you appoint an insolvency practitioner, right, they act as liquidator. They've got a legal duty to investigate the company's affairs. It isn't optional. They're not doing anything wrong. It's not excessive. This is what an insolvency practitioner is required to do by law. And their investigation typically covers a period of 2 to 3 years before the liquidation has commenced, okay? They're there to review bank statements, accounting records, any company books that they can get their hands on. And there are 3 specific areas where what they find can directly affect what you pay that insolvency practitioner. Now, let me start with directors' loan accounts, or DLAs, as it's commonly called. Now, I want you to please pay attention here. Your director's loan account is essentially the running record of money that has moved between you and your company outside of your salary, okay? Now, if you've taken drawings from the business, you might have used company money for personal purchases, you might have borrowed some money from the company, that is going to sit on your director's loan account. And if that balance is in debit, meaning you owe the company money, that overdrawn director's loan account is classified as an asset of the company in a liquidation scenario. And the liquidator's job is to pursue it because it belongs to the creditors. It's essentially creditors' money. Now, let me give you an example of how this plays out, okay? You take £1,000 a month salary. But every month you pay yourself another £3,000 and you might call it a dividend, okay? But it only becomes a dividend at the end of the year when your accountant puts the accounts in and declares that dividend out of profits. Because remember, most of us are told that's the best way to take money out of your company, combination of salary and dividend. But if you're watching this video at this stage, the chances are your business is in debt and you're robbing Peter to pay Paul. Now, you may not have enough distributable profits in your company to declare that dividend. Let's say you've not been able to pay HMRC for the last 12 months. Well, you're insolvent. And when you're insolvent, you can't declare a dividend. So that £3,000 a month that you've taken in your head as a dividend, it's probably going to get reclassified as a director's loan account. And here's where this additional fee conversation becomes very real. If you've got an overdrawn director's loan account, the insolvency practitioner, they've got to investigate it, right? They've got to quantify it. And then they've got to formally write to you requesting repayment, okay? They're not doing anything wrong. That is their job. My gripe is some firms are open and transparent about this and they'll tell you at the start, we've got to look at things like directors' loan accounts. My belief, if anyone is quoting £2,000 or even £3,000 to liquidate a business, they have got a good idea that there is going to be an overdrawn loan account and they are going to be able to pursue it once they're appointed. And every one of those steps when they are pursuing a director's loan account is billable, okay? And those rates could be from £200 to £500 an hour depending on who's doing the work. So a director's loan account investigation, even on a modest overdrawn loan account, can add tens of thousands of pounds to the total cost of your liquidation, okay? And here is the thing that most directors, that they don't realise, that insolvency practitioner can look back 2 years and they can challenge transactions relating to your DLA. You know, you might have wrote off a director's loan account in the past. You might have cleared it through a dividend that's actually an illegal dividend, okay? Like if the company was insolvent and you declared a dividend, the insolvency practitioner can seek to unwind it. And again, that's going to increase your director's loan account. Now, I've had this. I've lost count of the amount of times where we get an inquiry. Within 10 minutes, we can see on company's house that although this isn't accurate information, we can see that there's an overdrawn loan account in the last set of accounts. And we'll say to the director, well, how have you taken money out of the business since that point? And they'll say, well, I've continued to take salary and dividends. And then they tell me that they've been insolvent for 2 years. So I know that that director's loan account has gone up, okay? And I say to them, listen, this is not a £5,000 liquidation. It's almost the £5,000 to get it into liquidation. Because by the way, that's what a lot of firms charge at the moment. It's 5,000 plus VAT for standard liquidation, £5,000 or £6,000. I'm telling them, listen, what you need to be really careful about is your overdrawn loan account, because that is where you're going to be hit with additional costs. And what they'll do is, a lot of people will go, oh, Chris, no, I've got a firm that have said it'll go away for £5,000 plus VAT. And I'm like, there's no way in this world that you're going to be able to make that disappear. Or they'll come up with like a crazy idea that they're going to put in a massive wage slip on the last month to get rid of the DLA, or some weird and wonderful way of reducing that director's loan account. Because guess what? The only way you can reduce a director's loan account is to pay the bloody thing back or declare a dividend. And the fact that you're insolvent, you're speaking to somebody like me, means you can't declare a dividend, okay? And what happens is, a few months later, after I've warned them, they email me. They slide into my DMs saying, Chris, can you help me? What you've said has happened. And I can't help them. And there's only limited stuff that I can do even at this stage, because I'm not going to tell you any black magic to get rid of your director's loan account. What I'm going to say to you is, right, before you appoint an insolvency practitioner, sit down with your accountant and get a clear and documented picture of your director's loan position, up to date. So I've got an itchy nose at the moment. And what this is going to allow you to do is understand your position. Go through every single transaction. Make sure anything that you've legitimately owed, you know, business expenses that you pay personally, okay, has been taken into consideration. Make sure everything is properly documented and it's set against that balance, right? Go through your bank statements, go through your pay slips, have board minutes if decisions were taken about remuneration, because the more clearly you can evidence and legitimately reduce that director's loan account before appointment, the better the outcome is for you, okay? And the lower it will cost you. Now, again, do not try and rush a dividend through to clear the director's loan account at the end, because that's going to stand out immediately and it will be challenged and reclassified. It will be an illegal dividend, which means it will just get converted into a director's loan account. Now, you have got options when it comes to director's loan accounts, right? Okay, there are personal tax options, which I won't go into because you need to speak to your accountant about this. But when an insolvency practitioner is pursuing you for these director's loans, you do have the ability to negotiate a settlement in most cases, okay? Now, the key thing for you is you've got to show the insolvency practitioner what you can reasonably afford, you know, what's your income, what's your expenditure, what is your personal position when it comes to property and personal assets. Now, somebody who has no physical assets and has got no disposable income, in some cases can get an overdrawn loan account written off. And that is because the insolvency practitioner can't really justify the costs to pursuing that director legally. It's not really in creditor's interests. If you've got £1 million house with no mortgage, you're really vulnerable, okay? Because on paper, you can afford to pay that director's loan account back. I've got a job on at the moment. The guy is asset rich and cash poor. Like literally, he's struggling to pay his mortgage every month. But he's got hundreds of thousands of pounds of equity in his property. And the way that the insolvency practitioner is going to look at it is, well, if you don't get a loan against your house, really we should make you bankrupt because we get all the money back in a bankruptcy. The reason why a lot of insolvency practitioners don't want to go down the bankruptcy route, though, is it's quite costly. It's very time consuming. You know, it could be sort of 3 or 4 years before someone is forced out of the property and possessions taken. And that's quite risky because the insolvency practitioner will have to foot the legal costs till the possession is taken. And a lot can happen in all those years. So that is why in most scenarios, an insolvency practitioner will be able to do some type of deal. And again, this is something that we deal with day in, day out. Please pick the phone up, drop the details in the comment section below, and we can have a chat with you about directors' loan accounts, help you understand your position, and maybe even guide you on how to get a settlement done, right? The other area where increased fees are going to hit you is preference payments. Now, a preference payment basically is where, in the period leading up to insolvency, a director pays one creditor ahead of another. And it basically puts that creditor in a better position than they otherwise would have been. Classic example is you owe suppliers, you owe HMRC, and a family member's lent you some money, okay? And as the business starts to struggle, you pay back the family member in full. So you've used company money to do it, and HMRC and other suppliers have been ignored, okay? That is what we call a preference payment. And under the Insolvency Act, an insolvency practitioner can apply to court to have that transaction reversed, okay? So the money gets clawed back and it goes into the liquidation pot. It's meant to go for creditors, but generally when it's like cheap liquidation fees, it will be used for the insolvency practitioner's fees, right? You've got to be careful, okay? Now, you might think that this doesn't happen very often, okay? But it happens in a significant proportion of liquidations, right? Because when a business is under pressure, a director often completely misjudges the situation, and they try to protect people closest to them. They try to protect family. They repay creditors that they're friendly with. Now, when this is identified with the insolvency practitioner, they can come to you for that money, okay? They can, in the worst case, instruct solicitors. They can get you disqualified. But what's certain is, if you are found guilty of a preference payment, this is an area where it could cost you more fees. Now, what I want you to consider as well is, not every payment that you make at the end can be classed as a preference. But the lens you've got to look through is, if I make this payment, will it benefit creditors? So for instance, let's say in construction, you've got a supplier that wants 15 grand and you've got a supplier that wants 6 grand. But if you pay the supplier the 15 grand, they will deliver more gear at site that will bring in 30 grand to the liquidation. Well, in that scenario, by paying that supplier, you're bringing extra money into the pot. Now, if you are considering making any payments like this, I think it's a real good idea that you speak to somebody, speak to an insolvency practitioner, speak to an insolvency advisor, and let them know about what's going on. And sort of run it by them and go, listen, obviously I'm struggling at the moment, but I'm thinking of paying this. What do you think? Okay. Now, the third area, and this one catches loads of directors out, is something called a transaction undervalue. Now, section 238 of the Insolvency Act, it basically says a liquidator can challenge any transaction where a company disposed of an asset for significantly less than its market value within a specific time period before insolvency. So the look back period is actually, I think it's 2 years for transactions involving connected parties. So a connected party is like you as a director, family member, related businesses. Anything within that window is potentially challengeable. Now, what does this look like in practice? Well, maybe the company owns some equipment, a vehicle, or it might have been some stock. And as things were getting difficult in company A, these assets were sold probably to a related party, perhaps to someone connected to the company, okay? And the price agreed wasn't quite what those assets were worth on the open market, right? Or perhaps the assets were transferred to a director personally at a price that was convenient rather than commercial. Now, the insolvency practitioner is going to look at that transaction and ask, was there an independent valuation done here? Was the price genuinely market rate? Was this an arm's length deal? And if the answer to any of those questions raises any concerns, they'll pursue it. That's their job. Again, they can apply to court to get the transactions reversed. And what they will do is they'll pursue the director. And the fee implications here work exactly the same as the other areas. Any type of chasing, any type of work that they've got to do is added to the cost of liquidation. Now, again, I'm not saying that that's the insolvency practitioner's wrong. That's what their job is. Their job is to investigate your conduct, see what's happened with the assets, report back to creditors. This is just another area that those cheap liquidations are going to become more expensive. Now, what should you do? Well, if you've sold company assets in the last 2 years, or you're thinking of selling company assets, excuse me, even in your head, you've done it straightforwardly, you need to make sure you get proper documentation. Like, get an independent agent to value those assets. Especially if you're a connected party. If you are selling assets to another business that you own, or your family member, or you're buying them personally, you've got to demonstrate that you're paying fair market value for them, okay? Now, if you're still trading, you're considering liquidation, and you've got assets and you're thinking of selling them before you appoint the insolvency practitioner, listen, you can do that, but you're going to be deeply scrutinised. So you want to get an agent to value those assets, and you need to get the agent to recommend the offer that you're making for them, right? Don't sell them to yourself or to another company on the back of a fag packet, okay? Clean, documented evidence is going to be required from that insolvency practitioner once they are appointed, okay? So listen, let's come back to where we started. You've seen a firm advertising liquidation for a couple of grand. Now you understand, I hope, why that number on its own tells you almost nothing. Because what that 2 grand actually buys is to get you into liquidation, or get the company into liquidation. It is the entry fee to the process. And what happens next depends entirely on what the insolvency practitioner finds when they start doing the job. Now, my belief is if you've been quoted 2 grand, they're definitely going to find an overdrawn director's loan account. They're going to chase it. They've probably found some other things that they're going to unpick once they get appointed. And it's going to cost you a lot more money. Now, let me be absolutely clear about something, right? The insolvency practitioner who pursues those things is not doing anything wrong. They're doing their job. They are acting in the interest of creditors as they are legally required to do so. The law is designed this way deliberately. It's to protect the people and the businesses that your company owes money to. The problem's not the investigation. The problem, in my viewpoint, is that nobody told you before what was going to happen. And that is the real gap in the market. It's not the price. It's the information. A director who goes into a liquidation with a properly reconciled director's loan account, who's had somebody review their transactions, they've had a look at any sales that have been made and again review it, that director is in a fundamentally different position to one who has just rushed in and signed up with a 2 grand liquidation. Now, I want to give you a practical checklist, okay? And this is to help you navigate these waters going forward, right? So, think of this, if you will, as your pre-liquidation checklist. First, go and speak to your accountant or your bookkeeper and get your director's loan account properly reconciled, okay? Go for every transaction. Especially larger irregular payments, okay? Make sure everything that you are legitimately owed from the company is documented, right? If you've not taken some salary, that can be taken off your director's loan account. Now, any genuine expenses that you've funded personally, as long as you've got receipts, The idea is to get a true and accurate picture of your director's loan account at the point you appoint the insolvency practitioner, okay? Second step, stop taking any further drawings, right? Every additional drawing that you take that isn't salary is going to deepen that director's loan account. It's going to be scrutinised towards the end, right? Third, do not make any payments that could be construed as a preference payment, okay? If you are considering making any significant payments to any creditor, especially a connected one, get some advice, okay? What feels like the right thing to do morally can be the wrong thing to do in the eyes of the insolvency practitioner. Fourth, if you've sold assets out of the business or you're considering selling assets out of the business, make sure you document everything. Pull together valuations, sale agreements, invoices and correspondence. So when the insolvency practitioner gets appointed, you can show them your rationale for selling those assets. And fifth, and to be fair, I think this is the most important, get some advice quickly. Not a comparison website, not a firm whose pitch is entirely on price. Speak to a licensed insolvency practitioner. By the way, I'm not one, right? But I work with lots of them. I am, though, the UK's #1 director advisory firm. And we do put the director first. We're not here to show you how to cut corners or break the rules. We're going to actually help you understand your position in full, okay? A good advisor will tell you honestly what your issues are, even if it's uncomfortable, right? So, what do you do now? I want you to pick the phone up, okay? I want you to give us a call if you've liked what you've said. Because when I went through my own insolvency, I didn't have any of this information. Nobody sat me down before I appointed them and explained what was going to happen. It was all quite rushed. I want that to be different for you. This doesn't have to be complicated. The fundamentals are fairly straightforward. Reconcile your DLA, don't make preference payments, handle asset sales properly, get advice before it's too late. None of that requires you to be a rocket scientist. It requires you to have the right conversation with the right person before the clock starts. And if you're sitting there thinking, you know what, I might have some of these issues. I've done what he told me not to do. Well, listen, don't panic. It doesn't mean you're in a hopeless position. It just means you need proper, experienced advice quickly. So, I hope you found this video useful. And I've actually put together a video there of all the things you should be doing before you liquidate a company. And I suggest you go and have a look at them. My name's Chris Worden and I'm from Director First. Thank you.